The liquidity you see on public exchanges right now is a mirage designed to distract you from the real movement happening behind closed doors. While retail investors are arguing over short-term price action, we are witnessing the most aggressive drying up of over-the-counter desk liquidity in the last 5 years. If you are currently holding Bitcoin or considering an entry, you need to understand that the market structure is shifting away from retail speculation entirely. You are at risk of selling your assets to entities that have a time horizon of decades rather than weeks. The reality is that the era of MicroStrategy standing alone is coming to an end, and a new phase of corporate accumulation is beginning. In the next few minutes, I am going to walk you through the specific data points that prove the corporate treasury floodgates are opening for the year 2026. I will explain why the new accounting standards are the catalyst we have been waiting for, and how the supply shock will look different this time around. Let us get into the weeds of what is actually happening in the corporate debt markets. For the past 4 years, MicroStrategy has operated as an anomaly in the traditional financial sector. They utilized the strategy of issuing convertible notes to acquire Bitcoin, essentially leveraging cheap debt to buy a pristine asset. Most observers dismiss this as a reckless gamble by a single executive. However, looking at the recent filings from other publicly traded companies, we are seeing a distinct shift in tone and strategy. The data suggests that we are moving from the experimental phase into the standardization phase. By the year 2026, holding Bitcoin on a corporate balance sheet will no longer be considered an exotic risk. It will be viewed as a prudent fiduciary responsibility to hedge against monetary debasement. The primary driver for the shift is not price appreciation, but the changing regulatory environment regarding accounting. For years, corporations were held back by unfavorable accounting rules that forced them to record impairment losses if the price of Bitcoin dropped, but they could not record gains unless they sold. This asymmetry made it incredibly difficult for a chief financial officer to justify holding the asset. That changes completely with the implementation of fair value accounting standards. Under these new rules, companies can report their Bitcoin holdings at their current market value. This means that price appreciation will directly reflect on their quarterly earnings reports, boosting their earnings per share. Here's why this matters for the market cycle we are entering. We are already seeing a 30% increase in inquiries from mid-sized capitalization companies regarding institutional custody solutions. These companies are not buying to trade, they are buying to hold for the long term. When a corporation buys Bitcoin for its treasury, that capital is effectively removed from the circulating supply for years. We call this the illiquidity sink effect, and it is currently accelerating at a rate we have not seen since late 2020. The difference now is the scale of the capital involved. In the previous cycle, we were excited about companies buying $10 or $20 million worth of Bitcoin. The mandates we are tracking for 2026 involve allocations in the hundreds of millions of dollars. This is capital that moves slowly, deliberately, and without emotion. If this level of detailed analysis is helping you stay ahead of the crowd, feel free to join our inner circle by subscribing to the channel for more intelligence. Now, we need to discuss the mechanism that will drive this accumulation. It is the evolution of the convertible debt strategy that MicroStrategy pioneered. We are beginning to see a copycat effect take place across the technology and energy sectors. Companies with strong cash flows but stagnant stock prices are realizing they can issue debt at relatively low interest rates. They can then use those proceeds to purchase Bitcoin, which has historically appreciated at a rate far higher than the cost of that debt. This creates a positive feedback loop for their stock price. As their Bitcoin holdings increase in value, their book value increases, which allows them to issue more debt to buy more Bitcoin. This is often referred to as the infinite money glitch in financial circles, but it is simply efficient capital allocation. The data shows that the spread between corporate bond yields and the annualized return of Bitcoin is widening. Smart corporate treasurers are looking at this arbitrage opportunity and realizing they cannot ignore it. By 2026, we expect to see at least 50 companies in the S&P 500 holding Bitcoin directly on their balance sheets. This does not even account for the massive inflows coming from the exchange-traded funds. The exchange-traded funds have provided the plumbing, but the corporations provide the sustained pressure. Another critical factor to consider is the changing narrative around environmental, social, and governance mandates. For a long time, energy concerns were a barrier to corporate adoption. However, the narrative has flipped as Bitcoin mining is now recognized as a tool for grid stabilization and renewable energy monetization. We are seeing major energy conglomerates exploring Bitcoin mining as a way to balance their load and monetize wasted energy. This turns an expense into a revenue stream and adds Bitcoin to their balance sheet at the cost of production. This vertical integration is the next logical step for the energy sector. The reality is that the supply of Bitcoin on exchanges is at a multi-year low. When you combine this supply shock with the incoming demand from the corporate sector, the economics become very simple. We are looking at a scenario where the available supply cannot meet the inelastic demand of these large entities. Retail investors typically sell when they see volatility or when they hit a psychological price target. Corporations, on the other hand, have investment mandates that prevent them from selling impulsively. They have board approvals and governance structures that enforce a long-term view. This means that as coins move from retail hands to corporate hands, the volatility of the asset will likely decrease over time, but the floor price will rise significantly. We are witnessing the maturation of the asset class in real time. It is also important to look at the global context of 2026. Sovereign wealth funds are the next layer of adoption above corporations. We are already seeing rumors and unconfirmed reports of smaller nation-states accumulating Bitcoin for their reserves. When a sovereign wealth fund enters the market, they do not buy on Coinbase or Binance. They buy through strategic, over-the-counter deals that do not immediately show up on the price chart. However, the on-chain data reveals massive withdrawals from exchange wallets that correlate with these institutional movements. The 30-day moving average for exchange outflows has hit levels that typically precede a major supply squeeze. This is not a coincidence. It is a coordinated accumulation phase by smart money. If you are finding value in this deep dive into market structure, make sure to like this video so we can continue to provide this level of research. Let us transition to the risks and the counterarguments. The biggest risk to this thesis is a regulatory crackdown that specifically targets corporate ownership of digital assets. However, with the approval of the spot exchange-traded funds, the regulatory risk has diminished significantly. The United States government has effectively legitimized Bitcoin as a commodity. It would be incredibly difficult for them to reverse course now that major asset managers like BlackRock and Fidelity are involved. Therefore, the path of least resistance is toward further integration into the financial system. By 2026, we anticipate that banks will be allowed to custody Bitcoin for their corporate clients. This will remove the final friction point for many chief financial officers who are hesitant to manage private keys or use third-party custodians. When a corporation can hold Bitcoin in the same bank account where they hold their dollars, the adoption curve will go vertical. You must also consider the macroeconomic backdrop of persistent inflation. Corporations sit on massive piles of cash that are losing purchasing power every single year. In a high inflation environment, doing nothing is actually a risk. Chief financial officers are realizing that holding 100% of their treasury in fiat currency is a guaranteed way to lose value. Bitcoin offers a way to preserve purchasing power without the counterparty risk associated with bonds or other financial instruments. This is why the narrative is shifting from Bitcoin as a speculative tech stock to Bitcoin as digital gold. We are moving away from the cycle of 4-year halvings dominating the narrative. Instead, the dominant narrative will be the absorption of the supply by the corporate sector. However, the potential for upside remains asymmetric because the market cap of Bitcoin is still a fraction of the global bond market or the gold market. Even a 1% allocation from global corporate treasuries would send the price to levels that seem impossible today. So, what is the playbook for the individual investor in this environment? The strategy is to front-run the corporate adoption. You have the advantage of agility that a large corporation does not have. You do not need a board meeting to approve your purchase. You do not need to wait for a quarterly earnings call to adjust your strategy. You can accumulate now while the liquidity is still available, before the corporate squeeze begins in earnest. The window of opportunity to acquire Bitcoin before it becomes a standard corporate reserve asset is closing. Once it is on the balance sheet of every major company, the valuation will reflect that utility. We are looking at a future where Bitcoin is as common on a balance sheet as cash or short-term treasuries. The pioneers like MicroStrategy have taken the arrows, and now the settlers are coming to claim the land. By 2026, the landscape will look entirely different. The companies that adopt early will outperform their peers, and the investors who understand this shift will be positioned to benefit. Do not let short-term noise distract you from this long-term signal. The data is clear, the trend is established, and the destination is inevitable. To summarize the strategy moving forward into this new era, watch the corporate filings closely, not just the price charts. Monitor the volume on over-the-counter desks and the inflows into the exchange-traded funds. Recognize that every dip is being bought by an entity with a balance sheet larger than you can imagine. Position yourself accordingly and hold on to your assets with the same conviction as a corporate treasurer. Please remember that I am a market strategist, and this analysis is based on data and trends. Nothing in this video constitutes financial advice. All investment decisions involve risk, and you should conduct your own due diligence or consult with a certified financial professional before making any investment decisions. The market rewards those who are patient and informed. Stay focused on the horizon.